Welcome to today's video. Have you ever wondered what happens when a U.S. Treasury auction fails? This scenario occurs when the U.S. government is unable to sell all the securities it intended to offer. Such situations are relatively rare but can transpire due to various reasons, including lack of investor demand, unfavorable market conditions, or pricing issues. When a Treasury auction fails, it's typically a signal of concern about the government's ability to borrow money, which can have broader implications for financial markets and the economy. However, it's important to note that failed auctions are relatively rare, and the U.S. Treasury has mechanisms in place to address them if they do occur. In response to a failed auction, the Treasury may take several actions to mitigate the situation. One option is to retry the auction at a later date, possibly adjusting the terms or pricing to attract more investors. Alternatively, the Treasury may opt for direct sales to large institutional investors or adjust its borrowing plans to ensure successful future auctions. Additionally, policymakers may consider implementing measures to address underlying economic issues if failed auctions become more frequent or indicative of broader economic problems. In case you are wondering how the U.S. borrows money or if they ever borrow money. Well, the United States government's ability to borrow money plays a vital role in financing its operations, especially when tax revenues are insufficient to cover expenses. This borrowing is facilitated through the issuance of various types of debt securities known as Treasury securities. These securities, issued by the U.S. Department of the Treasury, are considered among the safest investments globally due to the perceived creditworthiness of the U.S. government. Treasury securities come in different forms, including Treasury bills, T-bills, Treasury notes, T-notes, and Treasury bonds. T-bonds. T-bills are short-term securities with maturities ranging from a few days to 1 year, while T-notes and T-bonds have longer maturities, ranging from 2 to 10 years and over 10 years, respectively. Each type of security offers different features in terms of maturity and interest payments. The primary method through which the U.S. government issues Treasury securities is through auctions conducted by the Treasury Department's Bureau of the Fiscal Service. These auctions are open to both institutional and individual investors who submit competitive and non-competitive bids. Competitive bids specify the desired yield, while non-competitive bids accept the yield determined at auction. The Treasury then reviews the bids and determines the yield at which it will issue the securities based on demand. A group of financial institutions known as primary dealers play a crucial role in facilitating Treasury auctions. Designated by the Federal Reserve Bank of New York, these dealers participate directly in auctions by submitting bids on behalf of themselves and their clients. Their involvement helps ensure the smooth functioning of the auction process and broadens the pool of potential investors. While the Federal Reserve, the Fed, doesn't directly borrow money from the government, its actions significantly influence the borrowing process. Through its monetary policy tools, such as open market operations, the Fed can affect interest rates, which in turn impact the cost of borrowing for the government. Changes in interest rates can influence investor demand for Treasury securities and the overall success of Treasury auctions. Once Treasury securities are issued, they can be bought and sold on the secondary market, providing liquidity to investors. This secondary market allows investors to buy or sell Treasury securities before their maturity date. Additionally, foreign investors, including foreign governments and central banks, are significant holders of U.S. Treasury securities. They purchase Treasuries as part of their foreign exchange reserves or to invest excess funds. The Treasury Department is responsible for managing the government's debt portfolio efficiently. It monitors market conditions, interest rates, and investor demand to determine the appropriate mix of Treasury securities to issue. Additionally, the government operates under a statutory debt ceiling, which limits the total amount of debt it can issue. When the government nears this limit, Congress must raise or suspend the ceiling to allow for additional borrowing. However, government borrowing has several implications. Firstly, the government must make regular interest payments on its outstanding debt, which can divert funds from other government priorities. Persistent borrowing can also contribute to budget deficits, where government spending exceeds revenues, necessitating additional borrowing to finance. Moreover, large government borrowing can compete with private sector borrowing, potentially driving up interest rates and crowding out private investment. Finally, excessive borrowing raises concerns about the long-term sustainability of the national debt, as high levels of debt relative to GDP can hinder economic growth and financial stability. Be sure to give this video as if you are enjoying the content. Currently, uncertainty has resurfaced within the U.S. Treasury market, following recent actions by the Federal Reserve and the release of strong economic data. The dynamic shifts in expectations surrounding the Federal Reserve's interest rate policy are causing ripples throughout the fixed income market, introducing heightened risk for investors who had previously bet on the continuation of the explosive rally in bonds witnessed at the close of 2023. Towards the end of the previous year, investor sentiment was heavily influenced by the anticipation of rate cuts from the Fed, potentially as early as the first quarter of the current year. This sentiment fueled a surge in demand for treasuries, propelling government bond prices upward from their 16-year lows. However, recent developments, such as a surprisingly strong U.S. jobs report and a cautious stance from the Federal Reserve, have prompted many investors to reassess their expectations. The Fed's message, emphasizing the potential for an inflationary rebound if rates are cut prematurely, has injected uncertainty into the market. Consequently, yields on the benchmark 10-year Treasury, which move inversely to price, have experienced a notable increase in recent days, standing approximately 20 basis points above their December lows. Despite maintaining expectations for multiple rate cuts throughout the year, investors are now less certain about the timing and extent of the Fed's rate reduction actions. Concerns have also emerged regarding an anticipated surge in bond supply resulting from government issuance, dampening the optimism of bond bulls who had previously driven the market rally. Robert Tipp, chief investment strategist at PGIM Fixed Income, managing assets worth $794 billion, highlights the increasing divergence in potential outcomes, suggesting that 10-year yields could approach last year's high of around 5% from their current level of about 4.1%. Market sentiment is reflected in futures tied to the Fed's policy rate, which indicates a significant shift in expectations. Data from CME Group shows a decline in the probability of a Fed rate cut in March, with investors assigning only about a 20% chance compared to 64% a month earlier. Fed Chair Jerome Powell further tempered expectations of an imminent rate cut during last week's monetary policy meeting, emphasizing the need for greater confidence in inflation moving towards the Fed's 2% target. Powell reiterated this stance during a subsequent appearance on CBS 60 Minutes, reinforcing the message that the Fed remains cautious about premature rate cuts. Amidst the uncertainty, the probability of a first rate cut occurring in May has surged to 55%, up from 37% a month earlier. Investors are now factoring in a total of 122 basis points in cuts for 2024, a slight decrease from around 150 basis points estimated in mid-January. John Madzier, head of U.S. Treasuries and TIPS at Vanguard, the world's second-largest fund manager, had initially planned to buy the dip if 10-year yields reached 4.25%. However, he now contemplates initiating purchases at the same level with the view that yields might ascend further to 4.5%, reflecting a perspective of a prolonged period of elevated rates. Conversely, for some market participants, the retreat in treasuries reaffirmed suspicions that the previous year's rally had been excessive. Spencer Vakimian, CEO of Tullow Capital Management, a New York-based hedge fund, has been trimming exposure to long-term treasuries while augmenting holdings in shorter-term ones, anticipating that rates will stay elevated for a longer duration than initially anticipated. The apprehension among investors is exacerbated by the anticipated issuance of nearly $2 trillion in new U.S. government bonds this year. Many believe that yields will need to rise to attract buyers, particularly given concerns about U.S. fiscal health. Rating agencies Fitch and Moody's have previously warned about the strain higher interest rates could place on state finances. Matt Egan, portfolio manager at Loomis, Sales & Company, foresees 10-year yields reaching 4.5%, partly driven by the expected surge in government issuance. Interestingly, the rise in yields has had little impact on the stock market thus far. Unlike the equity sell-off triggered by surging treasury yields in September and October, the S&P 500 has posted gains of over 4% for the year and remains close to a record high. Despite the fluctuations, many market participants still anticipate a downward trajectory for rates as long as inflation continues to moderate. Federal Reserve officials projected 3/4-point rate cuts for this year in December, a forecast that Chairman Jerome Powell recently reiterated as consistent with policymakers' views. According to Jason Pride, Chief of Investment Strategy at Glenmead, strong economic data may alter the timing of rate adjustments, but the underlying direction remains unchanged. He suggests that while the pace of rate cuts may be slower, the potential for future cuts remains on the table. And that's a wrap on today's video. If you found this content valuable, don't forget to hit the like button below, leave a comment sharing your thoughts, and be sure to share this video with your friends and family. Your support helps our channel grow and reach more viewers like you. Thanks for watching, and I'll see you in the next video.